This week, the market gave us about as clean a textbook bottoming pattern you will see in real time. And if you missed it, well, don't worry. I am going to walk you through exactly what a short-term bottom looks like on a chart, how to recognize one while it's forming, and importantly, how to know when the pattern fails. After the end of this video, you will be better prepared to spot one next time it happens. So let's get into it. Let's set the foundation first. A short-term bottom isn't a single candle. It's a sequence, usually 3 candles working together. And those 3 candles have a name: capitulation, retest, and confirmation. Don't worry if you don't know what that means. I'll show you exactly what they look like this week on SPY and Qs when we pull up the charts. The first candle is capitulation. This is the panic flush. The signature is a long lower wick or a long red body that gets aggressively bought back before the session ends. The price goes down further than feels reasonable and then closes well off the lows. What you're looking at is a moment where everyone who was going to sell, they sold, and someone bigger than them stepped in to absorb it. The wick is the visual fingerprint of that absorption. The second candle is the retest. The market goes back down to test whether the low actually holds. This is the candle that fools most newer traders. Price approaches the prior low, fear comes back, and people who held through the capitulation finally crack and sell. Right at the moment the pattern is succeeding, not failing. If the retest holds, meaning the candle closes back above the capitulation low, ideally with another lower wick, that's the second piece of the bottom locking into place. Now, here's exactly how it played out last week. Pull up your QQQ daily chart, Tuesday, June 9. The big red candle opens around 724, closes around 708. But look at this wick. It peers down to about 688 before getting bought back hard. That's a 36-point intraday range. That's the capitulation candle we have been talking about. The market sold off violently, then someone with the size stepped in and walked it back up 20 points off the lows by the close. And if you only looked at the close, well, you saw a red day. If you looked at the wick, you saw the absorption. Wednesday, June 10th, CPI hit hot. Trump pivoted on Iran. The headlines were ugly, and yet the market held. QQQ opened around 700, made a low near 688, the exact same level as Tuesday's wick, and then closed back above around 700. That's the retest candle, 2 consecutive days hitting 688 and getting bought. That level just became significant. If you watched only the CPI headline, you panicked. If you watched the chart, you saw the same buyers from Tuesday show up again at the same level. Thursday, June 11th, the engulfing rally. QQQ opened at around 700 and closed around 720. A 20-point body, no real wick down, strong close into the highs of the day. That candle engulfs both Tuesday and Wednesday's price action. Trump called off the planned Iran strikes mid-afternoon, peace deal text approved, and the buyers who had been quietly absorbing for the past 2 days finally got aggressive. That's the confirmation candle. Same pattern on SPY. Tuesday opens 744, closes 736. Wicks down to 723, that's capitulation. Wednesday opens 736, plunges back to 723, closes 731. Retest of the exact same level. Thursday opens at 730, closes at 741. That's engulfing rally. 3 candles, identical structure to QQQ's, both indexes flashing the same signal in real time. Okay, so the lesson here. When you see that sequence developing, what should you actually do? Well, first, don't chase the capitulation candle itself. The wick looks beautiful in hindsight, but you don't know in real time whether it's the actual low or just a pause before another leg down. Trying to catch the exact knife is a bad odds game. Patient traders wait for the retest. Second, the retest is your real signal. When price comes back down to the prior low and holds, that's your higher probability entry. Tighter stop, defined risk, and the pattern is now working in your favor. On QQQ Wednesday, the moment price held 688 and started building back towards 700, that's where measured longs got positioned with risk against the prior low. Third, the confirmation candle tells you the move has legs. If you missed the retest entry, the engulfing candle gives you a second chance with less optimal pricing but more certainty. The trade-off is this: you are paying up to know the pattern is working. Now, the part nobody talks about, this pattern fails sometimes, and here's how to tell. If price loses the capitulation low, meaning we close below the wick on a later day, the pattern is broken. The bottom was just a pause, not a real low. New leg down likely coming, so you size accordingly. Your stop is just below the low. Your risk is defined, and if it breaks, you're out fast. For this week's example, that level on QQQ is 688 and SPY is 723. If next week we lose these lows on a hawkish Fed Wednesday or any other catalyst, Thursday's rally become a lower high failure and we're heading lower. The pattern would be broken. The Fed meeting Wednesday is the binary event that decides this. If we hold above this week's lows through the Fed meeting, the pattern stays intact and we are probably heading back towards the highs. If we lose 723 on SPY after the Fed, we are in a different market. That's the honest read. The chart shows a textbook short-term bottoming sequence. Whether it holds depends on the news next week respecting the pattern. Sometimes the news cooperates and the pattern delivers. Sometimes, well, it doesn't. Your edge isn't in being certain, it's in recognizing the setup, sizing for the possibility it works and the possibility it doesn't, and letting the market tell you which one is true. I hope you found value in this video, and if you did, you know what to do. Till then, I'll see you in the next one. Bye for now.